So let's get into it.
I've made every single one of my clients cry.
Telecoms, sales.
HR is about creating environments where people feel safe.
Are you asking me why social media just moves so quickly?
What the hell's going on with the bank?
Can we move on?
It's not something that I want to put out there.
I will put it out there. Phil,
Daniel,
welcome to our podcast.
I'm privileged to be here. Thank you for the invite.
Well, I'm glad that you came down and have a conversation with us. I've mentioned to you before we went on camera that we do it in order to add value and give some actionable stuff to business owners and people out there. For everybody who doesn't know Phil is a IFA, a financial advisor.
Correct.
Has been for over a decade.
Thank you for reminding me.
That's
repeatedly.
okay, sir. Don't worry. I've been in IT for just as long. So, over a decade. I keep it over a decade. It's easier than going to all the... I didn't realise that you were an IT engineer, though, before.
Back in my murky past.
Yeah.
I was, syseng back in the day, messing about with SQL servers and things like that. Doing first line support.
Little techie in there was him calling us a nerd earlier on when we were talking, Chris. Secret techie.
But then, I moved out of my bedroom and decided to venture into the real world.
And went tech, financial advice. Why not go into finances?
Try a little bit of something new.
Yeah. And you're liking what you're doing. You love what you're doing, obviously.
Love what I do. There's a few similarities, I'm sure, about helping clients and all those kind of things. And, you start with something, make it better.
Yeah.
Quite enjoy all that kind of stuff.
You go for, as it does state on your LinkedIn profile, and I've heard you say many times, a holistic financial planning.
Yeah.
For all of us brutes that don't understand, what's the difference between a holistic financial planning and financial planning?
Okay.
Because I think when I think of holistic, I'm thinking oils, candles. We're going.
We can do that if it makes you feel more comfortable. What does holistic financial planning mean? Holistic financial planning is not just looking at one specific aspect of your finances. It's about having a conversation, understanding where you are today and what you want to achieve out of a variety of financial requirements or objectives, and bringing that all together in one plan. So that can bring in things like retirement for the future. It can bring in investments that you're doing now. It can bring in the tax that you're paying now and the tax you're paying in the future. It can bring in legacy planning for the kids, or school fees planning for children, or even grandchildren. So it's bringing all of those dreams together into one place and helping our clients achieve it.
So it's like the personal side, whereas a computer wouldn't take in all of those types of things to figure out what you should do for your finances. Right. A human being will. So
that that's a huge question that's coming up right now, certainly with the advent of AI and the steps forward, which you're far more comfortable with than I am.
Love AI.
I think there's an awful lot of cogs that are always moving in the financial industry or the financial services regime. But two of the biggest are communication and engagement. And when we work with clients in whatever format they may be, 18-year-olds all the way to the 80-year-olds, it's about understanding the emotions that sit underneath their desires.
Yep.
To really kind of peel off those onion layers, get to the real, the root or the core of what they're trying to achieve, and then help them plan from where they are now to get them to where they want to be in the future.
Which it takes a human to do that at the moment.
I think certainly in today's world, you'd be struggling to put a tick in a box, because there's a lot of people that don't fit into a particular box, as we all know.
Yep.
So we're all very individual people. So trying to, create a piece of, AI-driven or computer-aided financial advice just wouldn't work, because, I'm a bit of that, I'm a bit of that. Well, an advisor who's worth their salt would be able to, speak to that person and really understand what it is that really drives them. And, we have conversations frequently, I want £1 million in my pension pot. And it's just because they've heard somebody talk about it and that's what they want. But actually, what does that mean? I want £1 million. Why? Why do you want £1 million?
It's interesting. I had sat in that chair, we had a business coach, and he'd said to me that one of the first things that business owners say to him is what they want to, he asks, what do you want to earn? And they'll go, I want to take home £100,000. And he goes, you haven't calculated that figure. You've just done this and gone, that's so actually, why? Why do you want? And it's interesting that it's the same type
So
of
what
thing.
we've
where-
got in our kit bags, rather than saying, well, we need £1 million, we start with, well, what do you want at the end of it? I can figure out, and we've got tools and market leading software and systems that we can use to dial these numbers in and say, well, actually, if I want this out at the end of it, this is how much I need. And at this set growth rate, at this assumption of inflation and those kind of questions, we can get to how big the pot needs to be or might need to be at the end. It's far more interesting, far more exciting to say, listen, if you were to retire tomorrow or you wanted something tomorrow, how much would it need to be? And then I can put that person or that company on the right track.
On the right path.
But then we also need to build into it, Daniel, things like taxation. People don't really understand that as well as somebody like myself might, or my
Because
colleagues.
we're not taught taxation. It's not.
I heard a great comment from a colleague of mine just the other day. An accountant will tell you how much tax you've got to pay. A financial advisor will tell you how much tax you need to pay. So I can get you there.
I like that.
Where we try and elbow the tax man at every opportunity.
Of course, yeah.
That's everybody's aim at the end of it. We want to keep more of our hard-earned money for ourselves and our families.
Yep.
But we've got to pay some tax. And
Yeah,
that's fine. That's the
obviously, that's
environment
the way
we
the
live in.
world
And
works. Yep.
no problem with living in that world. It's right that we do fund it. But we don't want to be overpaying tax, and putting the right plans in place means that when we get to where we want to be withdrawing some of those investments that we've got, we're not overpaying our tax. And that starts with putting a proper plan in place at the start.
And do you find, so in the over a decade that you've been in
He's going to drop that infrequently.
financial advice, I might drop it sometimes. Do you find that business owners understand what they're actually doing for the future? As in, do they get the picture that it is what they're doing now is to help them later on, or is it? Do you understand what I mean?
So
maybe I didn't ask that question correctly, but
I think the conversation, and I have frequent conversation with business owners through the course of a week. There's a variety of issues or potential issues that we have with business owners. Firstly, let's face it, business owners are great at business because they understand their business. Okay. So they're in it, doing a great job as you're doing here at TCCB and the other companies as well. Fantastic. Do I expect you to know the ins and outs of corporation tax and inheritance tax planning and all those kind of things? Well, no, because it's not your skill set. Yeah. So you engage with professionals that understand those kind of environments and put plans in place that can mitigate that tax as much as possible. The other issue that we've got, the other issue that we experience with business owners frequently is that they put a value on the business and they think that that's my retirement. Well, that's fine. I think the problem with that is that a business owner has an emotional attachment to the business and can therefore think that the business is potentially worth more than they might think it is.
100%.
Or they think it's worth more than somebody else might be. Ultimately, just like buying and selling houses, it's only worth what somebody's willing to pay for it. So who knows what that's going to be in the future.
Of a sale, right? As long as both parties are happy.
That can all change. And when you sell your business, potentially there's tax to pay. Now, if you're selling a business, that's one transaction at one point in time, and who knows when that might be and whether it's the right time to sell it. You might need to sell it and you don't want to. What we do is work with business owners that through the course of that journey and up to and complementing that business sale in the future, and hopefully it occurs, we can mitigate corporation tax on the journey. We can put things in tax efficient environments that are outside of their estate for inheritance tax, because many business owners, they've got potential inheritance tax issues in the future. They've got larger estates.
Yep.
And we can help, like I say, mitigate those taxes.
Do you see that as a trend that happens quite a lot with business owners, that they are on that scale of, well, at this point in time, I will sell my business and that is my pot that is going to make me live for the rest of my life. But they're not thinking of the massive amount of tax that they would end up paying if you sell your business in one big chunk.
I think there's that, as well as coupled with, if we say business owners being a bit generic here, let's say they're in the 40s and 50s. We grew up, I'll show my hand here, I'm 46. But
older than me.
Don't look it. But at 46, I grew up in an environment with my parents whose pensions whittled away, weren't as worth as much, and were over exaggerated. And there was a huge amount of problems with pensions going back 20, 30, 40 years plus. We live in a very different environment now, but some of those preconceptions still exist because of the ways that we were brought up by our parents.
Yeah.
So there's a lot of business owners out there that look at pensions and say, well, I don't want a pension. Oh, they never make money.
Yeah.
Pensions have always done the right thing in so much as a pension itself will provide you tax relief at entry.
Yep.
It will provide you tax efficient income on the way out, and the growth within the pension is tax free. Now then, if you decide and take that decision not to engage with somebody to manage those investments, manage the taxation going in and manage the taxation going out, then yeah, pensions could potentially fail. They are complex beasts and they are ever evolving.
It's that old school thing as well, because up until very recent history, we were all working, or a lot of the country was working on government pensions and what you paid into your government pension pot, which, as we all know, is worth pittance, right? I've been paying into it since I was freaking 16 years old. But yeah, I can get what you mean by the mentality has stayed the same, and unless that changes, are you seeing? So do you work with business owners of millennials and Gen Zs?
Increasingly, yeah, because
Do they have a different mentality to us Gen Xers? Yeah,
we're right at the end of Gen X. I think
we are.
Gen X was the 80s when it stopped being.
It started. I think 76, 78 is the start of Gen X. So yeah.
Okay, so do I see a change? I think more and more young people are being encouraged at universities and educational institutions, to go and start their own businesses, and people are learning about the world and how it can work, and they're coming up with some great ideas. So we do see these 20-odd-year-olds coming in and building great businesses and starting out with a really great mindset at the start, saying, do you know what, I can do a bit of this, but I'm going to do a bit of this over here as well because it can save me money. And yeah, we deal with clients like that, an awful lot. I do want to pick you up on something though, and I'm not. This is just to. I don't want to drift down just like retirement. Yeah. It's very easy to do that. Yeah. You said about the state pension being worth a pittance. A lot of people don't know how much it's it's likely to be. Typically, if you
I don't know how much it's going to be, but I'm just going on general news coverage and people that I speak to that are already pulling off of their pensions. It's
interesting though, because you have these conversations. Oh yeah, the state pensions is rubbish, and I'm not going to get anything out of it. And then you ask them the question, well, how much is it going to be? Oh, it's going to be £100 every week, or £100 every 2 weeks, or £400 a month. And actually, you drill down into it. If you've done your 30 years of paying your stamp, currently it's about 10.5 grand. Next April, it's likely to rise to 11.5 with the triple lock that they've got in. So on its own, let's assume we've paid off our mortgages. 11.5 grand, you can just about live on, okay? It's not the retirement that a lot of us aspire to have.
No.
But if we use the Lego analogy, it's one building block to get us there.
Yeah, so you add into it different building blocks to make sure.
So if people want 20, 30 grand, well, that's fine. We can already take 10 grand away straight away, and then work on the other 10, 15. And then the interesting conversations come up about, well, the fact that at 40 odd years old, we're going to be 68 by the time we get our state pensions.
I'm never retiring. I've already decided I'm never technically I'm never retiring. So as in, I will never not have my fingers in some pie somewhere. The idea I will never sell. The idea is I will never sell this place. I was talking to a guy yesterday actually on a phone call that was looking to see whether I wanted to sell because he's trying to pick up business for other IT companies. I have no plans on selling. The idea is that this place will carry on going and will be handed down to my children if they want it. If they don't want it, it will still exist in the family because I want it to continue to pay me.
Legacy plan. Yeah. Absolutely. And, that's a great idea. And, knowing your beautiful wife a little bit, she probably doesn't want you at home either.
No.
So, that's a good, I kind of get that. But if your plan is then to maybe take your foot off the accelerator a bit and take some income from your respective savings and investments and retirement plans or whatever you might have, the state pension will kick in, but only when you're 68.
Yeah.
And some of the conversations
that
we have.
That's if it's 68. God knows where we're going to be. The way the world is at the moment.
Without getting all political about it, the NHS is a terrific beast. Best in the world, absolutely. But we're all living longer. And if we're all living longer, it's got to pay out more. It's underfunded at the state pension as it is.
Average age is 98 or 100 now.
I think it's 1 in 4 chance.
If you take them and they divide down, it's like
1 in 4 chance of living to 100, which is, amazing in itself. I think it's a really good point that you made. It could increase by from 68 to 69 and drift down to 70 potentially.
Who knows?
But then I'd come back to the point that I make to a lot of our clients is that why don't you just take control of your own retirement? Don't rely upon somebody else.
Mm-hmm.
The state pension is great when it comes, but if you want to go earlier or draw down on your retirement savings, currently you can do that at 55.
You have to have a private pension.
It's 55 at the moment that you can draw it. In 2028, I think it goes up to 57. So that might drift again to 60. But at 60, to be able to draw some money down, pay off outstanding debts or mortgages, or fund a standard of living that you want to have, take your partner, wives, husbands, whatever away on holidays, and maybe help the kids out, get on the property ladder. Who knows where that's going to go in the future?
God knows, who knows where the property ladder is going to be. We have a lot of estate agents on our books, and the conversations I've had with estate agents, I think I've mentioned to you last time, I've had conversations with my estate agents, I've had conversations with bank managers, all about the fact that we're technically, publicly not in a recession, but we are in a recession, because if the banks are lending on recession criteria, estate agents, first-time buyers are not getting on the ladder, so that's having a knock-on effect to all the rest of the chain that's going on, which then causes a knock-on effect to everybody.
Oh, that's yeah. But in Europe, they use a renting model. Very few people in Europe, buy houses. It might be seen as an outdated thing for people to own their own houses. We might be moving into that scenario where people just rent all the way through.
If you're the World Economic Forum, you'll own nothing and be happy about it, because that's from all the different things that I've watched, political stuff and non-political stuff. It's kind of the way the world. If you look, even at the smallest degree, IT, right? We've got so many clients that don't buy equipment anymore. They lease it or rent it, because in 3 years' time it will need changing.
Yep.
And why have that capex? And that's a small side. Then you scale that up and you go to, why the hell do I own a house? Why don't I just rent and take that headache off my head? Because why do we own cars? And then you get to that, we'll own nothing and be happy about it because we've got better things to spend our money on.
I think the only thing to put into that melting pot is you're in control of it, I guess, if it's yours. If you're living in somebody else's house and renting, the rents can change.
Fluctuate, which is a problem.
And it's a nice asset to have is a property. But, I think the banks were maybe a little bit guilty in the past of lending a little bit free and loose. And that's come back to bite them, as we've seen in the past. And they've put things in place now to stop that from happening, and affordability is cracked down. So
did you watch the King's speech yesterday?
I know you did. So
I caught some of it and saw that he had mentioned about them doing more to help with the housing crisis, or the fluctuation. That has a lot to do with the inflation. It has a lot to do with the economy at a whole, and the gazillions, we won't get political, but the billions that we are spending in aid for other countries. And I think from the business owners that I speak to on quite regular basis, in the different conversations I have, everybody's a little bit unsure, or a little bit, it's as though everybody's sat a little bit in purgatory. They're just like in limbo. They're in like this, do we do financial investment on our businesses to help them grow, or do we sit there and go, no, I'm going to wait and see what happens, because it's a bit scary.
And that's why communication and engagement, going back to those phrases that I used before, is so vitally important when you're doing your financial plans, to get somebody that you, to use that B&I phrase, know, like and trust, do your financial plan. So these are things that you only get kind of one shot at, in so much as I can't use that pound that I had in my 30s again. I've already spent it. So if I've got to put a plan in,
pounds in my 30s.
Tell me about it. Got some great stories as well.
Not for camera though.
One for another time, maybe. But you can't spend that money again. So we've got to put these plans in place at the start. We know that the same plan won't be the same plan at the end of it, i.e., let's use an analogy, the life cover that I took out on my first mortgage is not appropriate for the mortgage that I've got now. So we have to change it. So you put a plan in place at the start, and through regular reviews or meetings with your advisor, that trusted person that's working on your plan with you, they can get you from where you are right now all the way through that journey. I'm talking about relationships now that last 15, 20 plus years, and indeed drift down through the families. And I work with clients, kids now quite easily. I'm playing golf with one next week as it so happens.
Nice.
But
So that's what happens when you have a trusted advisor that understands you as a person rather than you're just a number on a page or on a computer screen. You build that relationship. Goes back to relationships, back to actually knowing the person and understanding. Oh, well, they've had this go on in their life, and that.
Well, I think your original question was about there's an awful lot of stuff going on. The world is a scary place. So our job as advisors is not solely to manage your tax and to manage your your income and expenditures and look at your assets and your liabilities and to manage the income that you're going to draw from your investments in the future. It's not just that. We also have a kind of an emotional arm to us where we put our arms around our clients, metaphorically speaking, and say, we've been through this before. Yes, we're going through a terrible crisis with what happened in Ukraine or is happening, continues to happen in Ukraine. And again, keeping all the politics out of it, what happened there had a huge impact across the globe. And it's not just in the UK. But if everybody can remember back in January 2020, when we were all quite happy and hugging our parents and, having lunches and dinners together and going out. And then
March came and they went,
space of 8 weeks, we went from being able to see our family members to, Jesus, how does Zoom work? And we all kind of found out in the space of 48 hours how to create a Zoom account. And don't we all wish we'd have invested then? I think the flip side, what I'm trying to make
I wish I bought shares in Zoom way before 2020. Oh, man.
You and me both, pal. But, those kind of conversations, we're going through something now with Ukraine. Yes, there's, a terrible situation over in Gaza in the Middle East, and that's another thing as well. My point is there's always something on the front pages.
Always.
We had COVID. Guess what, guys? We got through it. We had the financial crisis in 2000, 2008. We had the, the tariffs between US and China that happened in Q4 of 2018. Huge impact on the markets. There's always something that will drive it. Brexit, the prime example, whether there's benefits or not, whether it warrants us having a Brexit benefits minister is another thing.
It just costs me more money, Brexit did, because none of the kit that we supply is built in the UK.
Yeah.
So majority of it is built in China, like all IT equipment is, or in Taiwan or so forth. But majority of the headquarters, so HP stuff, Meraki stuff that we sell a lot of, comes from France and the Netherlands. There's an added tax onto everything that I bring into the country now. So you're right. There is always something going on that affects our economy and our finances, right? Whether it's little or whether it's big, like the financial crisis in 2008, we set up in 2008. Touch wood, we made it through a crisis. There's always something going on, but it is that being, I suppose, where a good IFA comes into place is because you've got that data, that mass amount of data that you can see the trends of how things have happened and you've been there before. Yeah. You can turn to a client and go, okay, so we've seen this type of thing before and we'll make some adjustments here and there and that type of thing where an everyday business owner looks in and goes, Jesus Christ.
It can be really, really scary. And, we've got various graphs that, in my industry, or certainly in my job anyway, we use. And one of them is this emotional life cycle of investing. And if you can just imagine it like a regular sine wave, going back to my maths days, but, up and down and things like that. People want to invest when the market's doing this and they don't want to invest when it's doing this. But
when you should be.
And that's the thing. And what you're doing now is basically offering clients these opportunities to buy things that are at a discount to what they were 12 months ago. And if you put it in those kind of contexts, why wouldn't you buy it now? If it was good stock, and it is good stock, and it's just undervalued,
it's going to end up going back up.
You're going to get the biggest wins out of what you're doing now. What you need to ensure, though, is that whoever of your, do you call them listeners or do you call them streamers?
Yeah, viewers.
Whatever your viewers are looking at, you've got somebody that they're working with that can understand, A, with the way that the markets work, have got a really market-leading proposition behind them, and understand the benefits of a diversified investment. And I think that's one of the things that really needs to come out today across all the investments that I use with my clients, it's not about putting all our eggs in one basket. That's what Granny told us not to do.
Yep.
Yeah.
Yep. 100%.
You know, oh, let's go and buy this because it's really, really good. But then all of a sudden, you know, it's not there anymore. Lehman Brothers, let's use that as an example because it's the first one that comes to mind.
Yep.
Too big to fail, and then it does, and then you snookered. So what you want to do is almost have a diversified basket of goods in line with your risk appetite, with equities being a part of it, potentially property, but things like bonds and fixed interest and gilts as well that can underpin those more volatile investments typically, albeit that last year showed us the difficulties that we had in the bond markets as well with certain things that happened in the world.
I think we found in the IT industry that only now towards the latter part of this year is buyer confidence going back up again. So we're seeing more businesses want to renew equipment, and whereas they've been delaying for the last 12, maybe 24 months, knowing they need to do it, but because of finances, the way the world's going, inflation and everything else, they've been delaying. But we're now seeing at the end of the latter part of this year that actually buyer confidence is going up a little bit more as inflation comes down a little bit, as we kind of are settling a little bit more, which has got to be the same for businesses wanting to invest and having more diversified portfolios, because there's a bit more confidence that the market is starting to bounce back.
You know,
up.
we've also got to remember, Daniel, that the monies that a lot of my clients are using today, the conversations that we have with them, this is not money that you will need for 5 years. So that's the starting point. We're putting money away now that we're not going to put touch for 5 years. Why? Because markets are volatile, but over the course of a rolling 5-year period, you would expect what we would call real returns. So returns in excess of inflation.
Yes.
Okay. So the money that you're putting away today, you're thinking, I'm not going to need it until 28, maybe 30, 2030 I'm talking about now, or indeed when I retire in 20 odd years time. So do I really care what the market's going on right now?
No, because
Arguably not.
it's course of time, isn't it? It's
So one of the phrases that I've heard used frequently, which I entirely buy into, is encouraging our clients to focus on the tide rather than the waves. Okay?
Yep.
So if we're focusing on the tide, we're looking at that longer picture. And that's far more beneficial than looking what's happening over the last 24 days, hours, whatever it might be. Because it doesn't really matter what's happening in the last 24 hours,
no,
24
you've got to think
days.
the long game.
This is for future money. So what we want to do is take advantage of, using that word once more, diversification. We don't know which market's going to do best next year. So what we do is we spread it around. It's almost like a patchwork quilt, because the top market performer from 2 years ago might only be the middle performer the following year.
Very true.
So what we want to do is spread it around that overall our portfolios can provide that positive return over the longer period.
Yeah, which then gives you a better outcome at the end.
Ta-da.
We touched on AI. AI's touching every single market, right? So I was at Microsoft headquarters at a conference yesterday, and even they spent half of their conference talking about AI and the markets that it's going into and where it's going to help. And there's some wonderful stuff coming. There's already some wonderful stuff out. It's been out for a year, right? October last year was when. So AI's been. Let me caveat that AI's been around for a very long time. The ability for the public to have access and use it has been around since October last year, and since then we've seen a massive AI boom, and everybody wants to use it. Is there any, from what you do, is there any inclination at the moment that the financial markets are going to start to use AI? It's like, are IFAs already using AI in some of the technology? Is there?
We don't use it in the company with which I work. We're not using that so much right now, but you know, we had something called robo-advice a number of years ago, 4, 5, 6 years ago, which was anticipated to be the next big thing. Never really took off.
People don't like talking to robots.
People don't like talking to robots. People like talking to people. However, we've got to bear in mind that everybody is an individual, and an 18-year-old's requirements for financial advice are very different to a 60-year-old's, and I'm using a very broad brush there. But, you know, you've got different requirements or different needs as you progress through life of varying degrees of significance. And as an 18, just to use an example, if you want to put 50 quid away, do you really need to be paying a financial advisor to do that? Or is it arguably just more important to be saving that 50 quid and doing something positive for the future?
Yeah.
Yes, we'd like the conversations, but there are cheaper alternatives out there. And by that, go to your local bank. You know, I'm not averse to doing that.
Well, you can't go to your local bank anymore because they're bloody closing. Right? And getting onto that conversation.
We'll get the Jack Daniels on and talk about that in a minute. But, you know, there's issues with that. We like to be accessible to our clients, just dragging it back into a bit of a sales technique here. My clients all have my personal mobile phone, and my phone goes on a weekend, and we get text messages and things like that. So we do. We always pride ourselves on being accessible to our clients.
Yeah.
But the needs of an 18-year-old, going back to that analogy, are very different to those as you get older in life. And it's far more important to get into that habit of doing regular savings and putting regular amounts of money away than it is to be planning about inheritance tax for the future, for example. But they will come across over, and some clients might, want it at £10,000 in the pension. Others might say, well, actually, when I got 50, I'll do it. Or some other, measure to put it against. But we don't. It's not right that we work with every client. There's no value that I can provide a younger potentially client or a client that's older that doesn't have as much money, because the scope for planning is diminished.
Yeah.
So typically we work well with business owners.
Yeah.
Obviously, we work better with high net worth and mid net worth, for want of a better phrase, individuals.
Is AI in the portfolio for investment?
We don't use it.
Got to that? No, I don't mean about using it. I mean about investing in it. So for instance, as part of the diverse portfolio that a business owner can have, is there already opportunities in it for some of that money to be being invested in AI, and because it is such a massive market?
Hugely. And with it being a new market, a lot of companies will fail and only a few will succeed. So I think you've got an element of risk to manage there. So again, going back to grannies and eggs in baskets, let's make sure we've got a diversified portfolio. But is there opportunities to invest in AI? Of course there is. You can go and set up a self-invested personal pension. Let's just use that, a SIP, which will allow you to individually invest in direct shares. So you can go and invest in your Zooms or whoever it might be that's doing
OpenAI.
There
Microsoft.
you go. Those kind of companies. Microsoft's a bigger beast. I mean, Microsoft absolutely will have a huge arm that's now involved and frantically working towards AI. Microsoft's a huge part of a lot of portfolios that are out there, and including ours. We've got exposure to Microsoft in a lot of our portfolios. So you're getting maybe secondary exposure to it by the companies that, Apple will certainly be around there, Meta will be in there, and those kind of companies, and they're all involved in a lot of the portfolios, given their weighting in things like the S&P 500. So they're going to be represented already in a lot of portfolios. But if you wanted to go and have direct exposure in one of those particular companies, something like a SIP would work for you. Or indeed, there's companies that allow you to open up individual investments or individual savings accounts, ISAs, that will allow that direct investment in those companies.
But then there's as with any new emerging technology, there's always risk investing in them. Just like there was in NFTs, because it was said the NFTs will go, 99% of them will go to zero, and they have. It was the .com boom in NFTs. What's your views on crypto and blockchain? More significantly, not so much crypto as in, because there's too many tokens and currencies out there, but the whole idea of blockchain, CDCs, that type of thing.
Okay, so I'm thinking about how to answer this question in a really positive way, because you and I have had this conversation before.
I had this conversation with everybody that sits in front of me, because it is the thing that gets me is the whole. So I'm old school, right? I like to have money in my pocket, right? Cash. We will quite often in the office, on my desk, when you go out later on my desk is a mug, and in that mug is 50p's and pound coins, because we have pound bets in the office. So if somebody believes that they're right and the other person is wrong, we'll put a pound bet on it. My pot is quite full, but I like cash. I'm old school. Then there's all the talk about CDCs and digital currency, and can they really ever get rid of having cash? Is it the future?
I think the cashless society is something that ultimately will happen.
We've been here. Come on. So you're a year older than me. So we've been hearing about cashless society for quite a long time.
But I think you've got a generational thing to wash out there. Where
Boomers and Gen Xers.
Those kind of people, or that demographic of society is probably a better way of saying it. But I think as people are coming through now, I mean, if I talk to, we've got kids of similar ages, when my kids get to 10, 15 years old, and I tell them that we used to record stuff over TV off of something that you put in, you had to rewind it before you took it back to Blockbusters, and like, which app did you use? It's like, no.
We
So
didn't use that.
that's the world has come on, and that was only like 25 years ago we were doing that. So there's going to be a huge change. I think going back to what you were saying about CDCs and
blockchain,
and cryptos and things like that, where do I see that fitting? I know that it's a huge talking point. Depending on when this goes out, there's the autumn statement coming up, and there's a lot of talk about the way that crypto will be legalized, legislated for, rather than legalized, legislated for is probably a better way of putting it, to make it less attractive, maybe, because ultimately, where does the revenue come from the government? So if that's the case, what you're going to do? I think a lot of people, I'm not quite sure what a lot of people use crypto for.
Yeah.
I think there's an issue there.
Oh, definitely. It's like with any emerging technology or with any new emerging system, PayPal, when PayPal was first brought out, those types of money apps, there are certain apps out there that can be used for nefarious things because they're untrackable and so forth. And yes, we all know cryptocurrencies can be used a lot for nefarious stuff. We can see bigger brands now taking on, going, I watched a video the other day, I don't remember who it was, but there is a bank in the UK that is now or a mortgage lender that is now accepting a particular type of cryptocurrency to pay your mortgage.
Okay.
And I get it. I'm a techie, so technology, I'm always want to fiddle with all different new pieces of technology. And I get that it can, but then that can be used for nefarious things. But then you can say that about nearly anything.
Yeah, but I think
AI is going to be used for a lot of nefarious things as well as a lot of good. My personal opinion on crypto is that we've got a bit of a boom going on where too many people are making money out of the stock market of it, if you get what I mean, the ups and downs of its valuation. My brain goes to, and this is probably because I'm a techie nerd, but have you ever seen the film Ready Player One?
Unfortunately, yes.
Yes. So virtual reality, but they use chips. It's digital chips. In a lot of the sci-fi films that money doesn't exist anymore. It's now a digital chip that is changed back and forward. So we're just getting there.
I mean, who knows? I mean, if we all knew that, if we knew the answer to it, we'd sell our house in the park. You up?
I'd be a millionaire.
Well, there
already.
we go.
Yeah.
And I've spoken to a number of clients who have believed you're not in this conversation as this so happens, but I've spoken to other clients. I'm just going to put a minimum into my pension and get my tax relief from a corporation tax perspective on those contributions. But the majority of my regular saving has been going into crypto. I've seen, So where do I go? You know what's coming next. It's a lean up to a punchline, isn't it?
Yeah.
Now their argument is, but Phil, I don't need this for 10 years, and you always tell me to keep my money back for or whatever I put away now. I'm not touching for 5+ years. Absolutely, but all those people that were buying Bitcoin back in the day, they've made their money now.
That's
those
been
Bitcoin
made. Yeah, you missed that
days,
train.
That's gone.
You missed that train. That train was,
I believe,
back in the beginning when it was cents on the coin. That was where you made
one of my best mates. Can't mention his name, obviously, but I'll talk to him by his first name, Simon. He was paid 3 Bitcoins for a piece of work that he did back in the day. And he bought his extension.
Yeah, there you go.
So, he's done well.
There's the story of the guy that paid to have the most expensive, back in the day, paid for a pizza, and I believe it was like 10 or 20 Bitcoins that he paid for the pizza, right? For somebody to buy him a pizza. All those 10 or 20 Bitcoins, when it hit its high of $65,000, Jesus Christ, that's like stupid money. That make you rich money.
But going back to that client who's
but
doing
it's
his
betting.
It's
gambling.
It's absolutely gambling, and who knows where it's going to go in the future. So am I absolutely against it? No, I'm not, Mary Whitehouse saying that you should never do that. What I am saying is by all means do it as a part of a diversified basket of goods.
Or dabble.
We don't touch it. In the company with which I work, we do not get involved in it simply because we don't necessarily understand it. And I'd argue with a lot of people that say that they do.
It's too volatile.
And you're trading in something that really, inverted commas, doesn't exist. So it's not a tangible thing that I can see and kick. So in that respect, by all means do it. It's not something that we want to be associated with the company that I work with. So have it as part of your whole entire wealth, but it's very much keep that aside.
I think a lot of people don't understand how much like gambling it is, though, is the problem.
I'd agree with you on that. And I think if you looked at it as, I'm putting 100 quid or whatever it might be that you're thinking about into crypto, that's the same as going down the track and putting it on what you think is the winner, and it shows up with 3 legs. But it's whatever you want, whatever analogy you want to make. It's very much. Yeah. It's a bet, and it might come off, and infrequently it does. And we've seen these almost penny stocks. I don't know what you call them in the crypto world, penny stocks. But those kind of 0.00004 of a pound, and it gets all it needs to do is go up to half a p, and I'm a millionaire. Well,
it's never going to get to half a p.
There's a reason. There's a reason why,
and it is very much like penny stocks. It goes back to I rewatched recently because I haven't watched it in ages. Wolf on Wall Street. Love that film, right? Absolutely brilliant film.
Yep.
But then trading penny stocks and selling penny stocks, and it's like, it's a bit before my time, so it was never it was never a thing when I was growing up, because it was also more of a American thing, penny stocks, than it was UK thing. But it's the same. I get that. I talk to people, quite a lot of people, and I have some friends who are very big crypto enthusiasts.
Yep.
And the next big thing, and this is going to be, and they run on the bandwagon, on the train. They're like, yeah, this is going to be it. I've got a couple of friends who have lost a fair chunk of money to it, and it's like, you have to understand it's betting for a start off, and it is very much, it's a gamble. It's very much, play with it. I play with it. Play with it, but don't invest your life into it. Some people have invested, like, sold up everything, invested everything into it, and then it's.
I've never had clients that have gone that far, but I work with business owners, and a huge portion of their hopeful future is invested in stuff that can swing literally by 50%, 60%, and has done over the recent years. Oh, but it doesn't matter because it'll come back. Well, I sincerely hope it does. I really do. But I tell you what, if it doesn't, or there's legislature that comes through that inhibits certain transactions or the way you can withdraw your monies, then there's going to be
paying
issues.
Tax on it. Do you know what I mean? So at some point the government's they have to get to a point where they go, that chunk is ours, thank you very much.
They'll have their pound of flesh.
Yeah. Do over the years that you've worked in the financial industry and in IT, I'm really thinking.
And in marketing, if we want to go back that far.
You were. I can't remember what the other one was.
EMEA, Europe, Middle East and Africa marketing exec.
Is there commonality mistakes that you see business owners make that if they didn't make them, they would be better off financially? Not just the biggest mistake of not having a financial advisor or investing in something, pension, whatever it is. Is there any, because you've probably spoken to hundreds, if not thousands, of business owners over the bit over a decade, 15 years, I think it was that when I was looking. So I've been running this company for 15 years. So we turned 15 last month. Last month was our 15th. Thank you very much. It was our 15th birthday. Is there any common mistakes that you see business owners make that if they didn't, besides the have a bloody pension?
I think the common one, and we touched on it earlier before, is a lot of business owners just think that their pension is, or their retirement income is going to be derived from the sale of their business. Mm-hmm. And they've got that emotional attachment to it. It's only going to be worth what it's worth on the day and you're only going to get what somebody's worth, willing to pay for that asset.
100%.
And not 100%, that's unfair. But in a lot of companies, the value of a business resides with the MD stroke CEO. And once that MD and CEO isn't there, if they haven't got a decent succession plan in place, you're going to have issues. Now, you probably talk with Howard about this, or other people in your networks. But that succession plan is really important. We work with people, specialists in their industries that can help get a business ready for sale. We work with an awful lot of those companies to make sure that it's in the best place for that asset to sell. But I think if you look at it as a journey, I set up this business when I was 30 or 40 to put all your eggs in one basket, and I keep using that phrase. The capacity for loss there, the margin for error specifically is so small that if it doesn't work, you've almost lost the guts of it. That's a huge thing. What about if the value of your business is only the asset in which you're sitting? It's the building and a couple of PCs outside or whatever it is. But the inherent value is you. And if you're not here, then why am I buying it? Yeah. So I think to speak to business owners, it's understanding that we can help you not just today, but all the way through that. You can put 60 grand away into a pension. I don't want to focus on that. I do far more planning than that. But if you can get 60 grand out of your business and save yourself 20% of that as corporation tax, I've just saved you £12,000. And that 60 grand has gone directly for the benefit of your family. Your hard-earned money has come straight out directly for you. Plus, it's outside of the estate for inheritance tax, which a lot of people don't realise. And plus, if you were to pass, if something were to happen to you, ultimately that money will go to your family. It doesn't go to the government. It doesn't go to your friendly financial advisor. It still remains within your estate.
It's that understanding that a financial advisor is there to help you across the entire journey with your financial estate, not just we can help you invest in this or we can help you. It's that it goes back to relationship, getting to know somebody, getting to trust somebody, so that it is same with us in IT. We get to know and our clients get to trust us, so they come to us with everything tech. Doesn't matter if we deal with it or we don't, or if it's they will still come and have a conversation with us before they do something. And that's kind of the same thing, I'm guessing, with a financial advice is before I've got this, I want to do this, I've got to have a conversation with your financial advisor and
that's why I don't, much to the annoyance of my wife, it's why I only have one phone. My phone's on. So if one of my clients rings me at a weekend or texts me at a weekend, it's probably because they're going through something and they really need an answer. So I'm accessible to that extent. And that's fine. People don't abuse it because they realise that it's almost a privilege. It's a privilege. Yeah, absolutely. 100%. I think on the flip side, though, you're looking at clients that I've worked with for a number of years. You've got that relationship. You've got that understanding where you're having conversations now around dinner tables or with other members of the family involved to understand what it is that they're trying to get out of it in the future. So you're all working together as a team. And I'm part of that almost, surrogate kid, if you like, brought into that family to help plan around that table what we want to achieve in the future. And I think I wanted to mention something that's just come out now about consumer duty. So historically, we had problems with pensions, and historically, maybe as an industry, we weren't always good at looking after and building relationships with clients. And sometimes there are advisors within the industry that didn't see the long-term nature of a relationship and very much saw it as a transactional thing at the start, where they went in, had a piece of business written, earned the income, took something every year, but didn't then build that relationship and put the time in to do that. Something that I'm very proud of is we see our clients every 6 months, because it's really important.
Relationship building that
relationship and understanding how things have changed. Not just
changes fast in 6 months.
So not just from your own family, but legislation and the government edicts that come out and market sentiment and market drift and all these kind of things we can talk about. That's why it's really, really important to have that relationship with an advisor.
The reasons behind doing this, because there's loads of people doing podcasts, right? I watch lots of them, right? Steve Bartlett, Joe Rogan. I love their podcasts and the guests that they've got on. But the reason why I felt the need to do one was because it's as though the small business owners, the owners like me, kind of left out of it. Because if you watch the Steve Bartletts, who's a multi-millionaire businessman, they're talking at a level of business that us smaller owners or small entrepreneurs would love to be at, but we're not there. So their conversations are a lot aimed at that level of thing, whereas I think there's a piece missing where the smaller business owners like
we're not multi-site, we haven't got 100 employees.
Exactly. where we didn't, like me, didn't get into business to be a business owner, because that's not what I started it for, right? I love and have a passion for IT, and I was an IT engineer and I wanted to do it my way, but it wasn't because I wanted to be a business owner and I wanted to know how to do freaking taxes and I wanted to know how to deal with human beings and all the rest of the rubbish that comes with owning a business. And because I've grown into being a business owner rather than starting off as a business owner, or with that mentality, I think that's the market. That's kind of the area we aim to not pitch at, but we aim to hit, is because there's tons of me's out there that are like, oh, I own a business, right? And what do I do with all? So one of the on the podcast that I had with Howard, we were talking about outsourcing. So I will outsource everything that is not within my niche.
Yeah.
So our books are done outsource, our accountancy is done outsource, anything that is our HR is done outsource, anything that is not our niche, we don't, because that's what other business professionals are for. That's why I want people to come to us, is to...
Kind of my job. You can do this yourself. I can change the tyre myself. I ain't going to change the oil.
Yeah, exactly.
If I've got a warning light on my car, I ain't thinking, oh, I have a bit of a fiddle. You go to a garage.
Might have a little bit of a Google and go, what is this warning light really serious? Do I need to worry about it?
It's like people doing the HR on their own. I know Helen used to bang on about it all the time. Whereas, I know what contract of employment is. I'll just write it myself. I've got my old one from 20 years ago.
Yeah.
I'll just use that as a template and just overtype it.
Yeah, but
then it goes wrong, and it's like,
because then you do it, because it is we're in the service industry. It's the same kind of ballpark or area, is that the reason we do what we do is because we know we know every little detail of it, so people can come to us and get the advice or get what they require because we know it. Same with HR. Whereas if you're a business owner and you don't know and you do it all yourself, there's tons of things that you're going to do as a mistake or that could end up crippling you or costing your business or whatever else, because you haven't employed the professional to go, you shouldn't actually do it that way because you're breaking this, you're doing that, and it's not cost effective or it's not efficient, or you're actually breaking legislation and rules. But it is that thing of, that's why you hire a professional. That's why we're in business. That's why we have jobs, right?
We'd like to say.
Yes. And that we're there to assist and help and all the good things, but we know what we do. We know our niche. And that's what I got from speaking to the HR lady, was because we spoke a lot about humans. You have to deal with humans as much as I do. My job would be a lot easier if I didn't have to deal with humans.
Yep.
Much like probably your job would be a lot bit different if you had to deal with humans. But that's part of our job and that's what we do. But we don't know everything. And that's why we got, going back to where we were saying, that's what the niche where I think we're going to fit with the talks that we do, is that thing of business owners like me don't know shit. We don't. We know our business, but until I met you, started talking to you and started to know you and started to invest and get my pension, I knew nothing about any of that crap. Yeah. Not a single bean. Like didn't even know I should be doing it.
We call them accidental landlords, don't we? Those people that, never set out to be a landlord, but, you get together with your partner, one of the houses, then do we sell it? Oh, no, let's keep it as a property. It's like, okay, I'm now a landlord and I need to understand all that kind of stuff. There's a lot of business owners out there that started off as one
business owners.
Yeah. And I don't want to manage anybody. I am, barely capable of managing myself, as my wife frequently tells me. But, I'm in here to help my clients and that's it. I'm not here to run a company that's going to take over everywhere. I just want to be very focused on delivery to my clients. And that's why where I work is really good, because I've got that support from a huge plethora of people that can help me deliver what I want to my clients.
It's the uncertainty. I think for me, it's the uncertainty, especially with the economic climate that we're in. Everybody's uncertain. If you don't know what you should be doing, then you just sit in this forever treading water. What do I do? Where do I go? Who do I? What do I do? And then you sit. I don't personally but people sit and watch the news and watch the TV, which a lot of the time is doom and gloom, and the world is destroyed, and the financial system is a wreck, and blah 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 blah. blah. Which fortunately, fortunately, Oxfordshire. I've said this quite a few times. Oxfordshire is a bit of a bubble because it doesn't really matter what's going on in the rest of the country. Oxfordshire is its own little
Microcosm.
Yes, thank you for the way. It's his own little microcosm, and because every business I talk to, so along the strip where we are at the moment, there is 5 businesses down the strip that are all independent businesses. Every single one of them is booming.
I can tell by the
There's
car park.
not one of them that is like struggling. Every single business owner along the strip that I sit and talk to, and we talk quite a lot, is business is booming. We're busy. Don't know what everybody's on about. But it's because we're in a microcosm. Because that's not how it is in the rest of the country, or so I'm told.
Yeah, I think I agree with you. That you get pockets like that do exist. The microclimates, microcosms, whatever you want to call them, which almost book the trend of what the world we're being told as is actually like right now.
Yep.
I think what you're trying to do is find those opportunities, no matter where your location is, or your geography, or your business, or your industry, or whatever it is finding those great investments. And again, that's what you talked about, outsourcing your needs for HR and things like that for a small while ago. My job is not to go and cherry pick a stock. That's not my job. I'm not thinking, the guy or the woman that runs the business next door to Daniel in Bicester is the right place to go. I've got a team of people that do that. It frees up my time to focus on what I'm good at, which is building models, building cash flow analysis, industry-leading software.
You. Yeah.
There's something coming through here, clearly. And I do enjoy doing it. But that's where, it really brings to life and brings off the page these numbers. And we talk about numbers all the time in our industry. But it's just black and white. It doesn't really mean a lot until you say, well, actually, that £300,000 or whatever it might be that you've got in your pension, what it actually means to you, Mr. or Mrs. Client, is the fact that you can have 1 holiday or 2 holidays a year. It's bringing to life then that I've been saving all this time, but what does £250,000 mean? What does £500,000 mean? What's
Not much nowadays.
Decreasingly less or increasingly less. But what we can do as advisors is bring that off the page, bring it to life almost, and say, actually, what this means is you can do this now in your retirement. You said you wanted a new car every 3 years. You said you wanted to go on holiday here. I don't care what it might cost in the future, because we can build in things like inflation and assumptions linked to that. What we can then say is, well, actually, what you need is, if you were to retire tomorrow, 30 grand. Well, that's fine. How do we get there from where you are? Because today you might be off track. So how can we bring you on track? Well, it might need a substantial investment. Well, you can't afford that. Well, that's fine. What can you afford? And what will this realistically give you in retirement? And what we're doing is making sure that when you come to draw on that money, and we're down that retirement rabbit hole again, but when you come to draw on that money, you're not going to bed when you're 64 and 364 days old, waking up the next morning expecting to receive a paycheck for 2 grand, and then 1,200 quid drops through the door, and you're thinking, what happened? Where did I go wrong?
Yeah.
And there's no point, inverted commas, there's always a point speaking to me, but there's no point speaking to me at 65 years old wondering, what could I have done? The time is when you're in your 30s, ideally, but typically a lot of business owners are in the 40s, and that's the time.
But then we're living longer now anyway, so the 40s is the
maybe that time
30s
has
is
shifted
new
to the right hand
40s.
side a little bit, absolutely. But those conversations that we can have through our 30s and 40s, which is typically when people, before 30, 40, they were building businesses. Every spare cent that they had went into building their business, buying the kit, buying the premises, scrimping and saving, all those kind of things. When you start to see the fruits of that coming through, then they start to engage with people like myself. Yeah. And it's then that we can start building these plans. So
I'm taking it from that. What I read from that is that it's never too late to start. It just, the outcome is based on what the input is, right?
So what it is, it's just like investment over the longer term. The value really comes from the sooner you work with me, the better. I still have clients, unfortunately, coming to me late 70s, early 80s, who've got a substantial inheritance tax issue. And the opportunities for me to help alleviate that burden that will be left to their families to pay, because it's not their debt, it's not their bill, the person that's unfortunately going to pass, it's going to be on the family, and they're going to lose potentially 40% of an awful lot of money. Okay, we can all.
I never understood inheritance
we can
tax.
we can discuss the cows come on whether it's the right or the wrong thing, and indeed, it's right on the top of the government's agenda right now.
Yes,
About whether that's going to continue in the future. But if that person had come to me 20 years previously, there's a fair chance that we'd have been able to alleviate all of that debt. They'd have all of that potential bill at the end of it. We'd be able to put it into something that was accessible to them, and ultimately 100% of it on their passing would then pass to their estate. So they're not losing any of it to the government. But the longer that period of time passes before you engage with somebody like myself, the less options that we have for suitable solutions that we could put in place.
Yeah.
Okay. So
Talk to a financial advisor now is what you need to do so that you can start the process.
how we do it all husky, is it?
Yeah.
Just like that scene out of Pulp Fiction.
The Bank of England have turned around and said that they're predicting a stagnant economy.
Yep.
What's that mean? To a layman like me, because I'm asking this question because I don't know what it means. I'm taking it from the word stagnant. It means we're not moving forwards, we're not moving backwards, we're just going to end up smelling worse, because stagnant water to me ends up stinking. So
There's a connotation. I think there's a bit of treading water. I think it is the forecasting low growth.
Yeah.
And if you think about it in terms of GDP, that's probably what they're referring to.
spent so much money over the last 4 years that
Do we really want to go down? Should we say
Well,
that for
yeah,
another podcast?
we can go down the rabbit hole. That's fine. On majority of the talks that we've done, actually, we've ended up, we've crossed across the issues that have come across over the last 3 years, because it's affected all of us, right? From being locked in our houses and not being able to see family, as we mentioned earlier on, to finances for businesses, being told don't go into work.
Yep.
Staff have got to work from home. Businesses, we had a few clients close their doors. Touch wood, not us and not a lot of our clients, but some of our clients literally closed their doors because they were like, we can't function. Got no money coming in, got outgoings. So we've all been through that struggle, and I think the only silver lining out of that period of time is that we were all in it together, as in we were all going through that situation. Everybody had the same rules to apply, or the same rules were applied to them, should I say, apart from us in the IT industry, because we got to drive anywhere we wanted during COVID, because we were keeping infrastructure working and functioning, but we all have gone through it. So it is one of those talking points that we've spoke about a lot on our shows, is because it's happened. But as a country, we spent a hell of a lot of freaking money that technically didn't exist because it wasn't there. And now as the taxpayer, we're paying back that money in one shape or another, which can only have an adverse knock-on effect to the economy. I don't see it. Where my brain doesn't understand it, where your brain will, is government printed loads of money and spent loads of money, right? Now government needs to pull back that money, so they've gone taxes in whatever way, inflation, in whatever way the money is coming back. That, yes, helps the coffers of the money they spent, but how does that not make us stagnant? How does that not make us go in reverse as an economy? Because we've got less money, as in we, the human beings that are not politicians and whatever else, have got less money to spend. Everything's more expensive to spend. For me, I don't see the light at the end of the tunnel.
Well, wages are going up again now. So wages have hit, I think, a 6 year. It's at a high anyway over a period of time.
That would be fine if they were paid by the government, but they're not. They're paid by business owners
who are passing those costs on.
Yeah, so we have to then raise our prices, which
increases
then
taxation.
and we're in that vicious circle.
But I mean, I am not an economist, so that's the first thing that I want to say. So I just see, if we choose, what you're talking about there, how does that relate through to monies that people are investing or putting away, and how does that help the UK economy? Well, I think the UK economy, typically speaking, broad brush, provides or contributes about 3% of global GDP. Okay, global GDP. So if the UK in effect funds 3% of what that is, and a typical medium risk investor might have 3% in the UK, we're not just looking solely at the UK market. Actually, that only forms quite a small part of our investment. I think the other really interesting thing is, of that 3% that is invested in the UK, and I think a lot of your listeners or your viewers will know what the FTSE is, the FTSE 100. So it's 100 biggest companies in the UK. 70% of those are not really UK companies, okay? So these are 70% of those companies don't present their earnings in pounds sterling. They'll present in other denominations, US dollars and things like that.
Yep.
So actually, what's the impact for their business on the UK economy? Actually, probably little. So my 3% that I've got in the UK, of which 70% is outside, I've now got 0.9% of my investment is in the UK, and companies that are actually listed and operate and publish their earnings in pounds sterling.
Pay UK taxes.
Again, let's not do that for today, but he's trying to drag me down a hole and I refuse to go down there. But, it's only a very small subset of our entire investment sitting in the UK. My outlook for the UK, I think the UK has been really, really strong over the past, few years. It's done remarkably well. The problem was with the bond market last year, or the gilt market last year, and what happened there. But the UK stock market has actually done really, really well. Okay. I think pre-COVID was, just punching shy of 8,000, and it's up at about 7,450 today.
Okay, so it's not done too bad.
It's not done too bad
compared to the rest of the world,
comparatively speaking. So I think if you look at it in those contexts, it's a long game, and it's about picking the right companies and the right stock and the right equities, those right investments within those various asset classes, within those various geographies, which is what our fund managers do, so well.
Yeah, I think as a business owner, as a small business owner, it's a worry, because we look at, you only see the news, or you talk to professionals bank managers and so forth, like I've had conversations with, who tell you stuff, and it's like, yeah, but what does that mean? But then if you look at it in the fact of it is a long game, and much like you would with an investment, you look at it in the long game, because it doesn't matter what it does now, as long as you've got a solid foundation or a solid base, which, touch wood, and I can only use us as an example, we do, because we've made it through one recession already, we've made it through COVID, we've made it through lockdowns and so forth. As long as you've got that solid foundation, you should be able to ride.
So to bring that into the language that we use, when we sit with clients and discuss what they're trying to achieve, before we'll take a penny off them, we understand where they are today. And every single investment will start with, tell me about your emergency fund. People say, well, what do you mean an emergency fund? Well, an emergency fund is if you need to lay your hands on money straight away that will last you for the next 2 or 3 months. We need to make sure that that's in place before we start thinking, well, I've got £10,000 in my bank, I want to invest 10 grand. Well, no, hold on. If you're spending £3,000 a month, I'd sooner you had £10,000 in your bank to cover you for 3 months. If the boiler breaks down, or the car needs a new tyre, or if anything like my wife, you need an emergency holiday, where do you go to draw that money from?
If my wife watches this, emergency holidays do not exist.
I adore her completely. But the thing is, that's the starting point. So it's almost like the bedrock of, they call it Maslow's hierarchy of needs. And, you start off with that emergency fund at the bottom. It's only when we've covered that off, then we can move up this pyramid, if you like. Yeah. And the next step up there is then protection. So I love talking about investments because they excite me. Pensions excite me because to me, in my nerdy little brain, I enjoy doing things like that. But before we get to investments, we've got to look at protection. And protection is making sure that if you weren't here, or indeed weren't able to work, when you're looking down from your cloud, or up through the grate if you're other clients, but if you're looking down from your cloud, how would you like your family and what you're leaving behind to look? So
what does that look like? So we have spoke a lot about pensions, a lot about investments, but what does protection look like? What does, for a small business owner, what should they be looking at? What
There's a huge amount of things that are available to business owners and individuals alike. So in its easiest form, we understand what a mortgage is, and we take out life cover to cover that mortgage. So if something would happen to us during that term, the bank would pay out, or the provider would pay out sufficient to cover the debt that we owe to the bank.
Yep.
Therefore, at least what I'm leaving behind is the house, and it's all paid off, and let's
Family's
just kill me
got
off.
it and good.
My wife and my kids have got somewhere to stay.
Yeah.
Well, that's great. But there's other things. For things like business owners, we've got income protection. So let's just imagine that terrible scenario where, for example, you weren't able to work. If you weren't able to work, there are insurances that you can take out that would allow you to, well, the business in effect would receive some money and would then be able to pay you an income.
Yes.
So that's executive income protection, and it's paid out after what they call a deferral period, and the deferral period is anything from a week or a month to 6 months, 12 months.
Yep.
And the only difference being that if it pays out after a week or a month, it's going to be far more expensive than if it were to pay after 6 months, because there's a lot of things that keep us off work for a week.
Yep.
Sounds like I've got COVID. I've promised everybody that I haven't. But, if you've got a cold, you can be out of work for a week. That's fine. But if you're off work for 6 months, then there's something more serious. So arguably you should have
If you're a
it.
business owner and you're out of work for a week because you've got a cold, you have problems.
Well, we've got things like that. I think one of the things I enjoy speaking specifically to business owners about is there's things called relevant life policies, and let's just touch on that for just a second. Many people probably didn't know they existed up until maybe 5 years ago. They have been becoming more and more commonplace within businesses. And what a relevant life policy is in effect, we term it as a one-man death in service. What does that mean? It's a life policy written on ourselves or indeed a member of your staff. The payment for that relevant life policy is seen as an allowable expense in the eyes of the HMRC, which means that in effect we can take out life cover for ourselves through the business and not pay any tax on the premium. And how much is another question.
We learn something every day, because I didn't know about this, but go on.
So relevant life policies, and historically they could only be life cover, but there are increasingly products that are coming through that also have critical illness cover associated with them. And you can pay that from the business. It's an allowable expense, so you don't pay corporation tax. In effect, it comes off that bottom line.
Is it much like a pension in the fact of the company doesn't pay corp tax on it and you don't pay tax on it because it's not coming out of your...
Right. So it comes straight to... It's not a benefit in kind.
It's not. That's what the word I was looking for.
So you can pay that from the business, and that can be a great thing to do. It's not designed to pay off mortgages. So it's not, I've got a £400,000 mortgage or whatever you've got, I'll take out a £400,000 relevant life plan. What it allows you to do is say, well, actually, it's a multiple of my earnings. So if I earn £50,000 and I want 6 times death in service, I'll take out a policy for £300,000.
Okay.
So it's done as a multiple of earnings rather than for a specific debt.
Okay.
So protection, we've done the life cover piece, we've done executive income protection, we've talked about relevant life policies. One of the biggest and most probably underused protection policies is what they call family income benefit. And family income benefit is, it's a huge benefit at a tough time. If I was to take out family income benefit on myself, and indeed do, if something were to happen to me when I wasn't here, a tax-free income would be paid to my estate or to whoever my beneficiaries are. So if I wasn't here, they would get a sum of money for a period of time. So for the next... My youngest is 3, so for the next 20 years, 19 years, 20 years, to take them through to hopefully the end of their masters, a sum of money would be paid out every month to cover my, in effect, the income that my family gets from me.
Yeah.
So my mortgage is paid off now.
Yeah.
They also get a tax-free income, then they can use as they want. Well, why wouldn't you just have life cover, Phil? Well, the answer is, A, it's cheaper, because why? In 10 years' time, the income will only need to be paid out for 10 years. Whereas in 10 years in life cover, you'd still get the big wedge.
Yeah, I get you.
I think the other thing to note is that at that difficult time for my family, when they're all, dressed in black and veiled and sobbing at my graveside for weeks
I want my family all in like bright colours and having a bloody party.
But at that difficult time, they've not got to figure out, how am I going to invest £400,000 now? They don't care about
Phil
that.
was the financial advisor going, now I've got this money, what do I do with it?
Well, I've got £400,000. I now need to turn this into an income. They don't need to worry about that. They've got now an income that's coming into the house every month, regular as clockwork, and the house is paid off. So now they can live a life that they were used to.
Yep.
One less person, obviously, and it's not covering my entire salary because it'd be pointless to do that because the house is paid off.
Yeah.
And I'm not there.
But it
as well.
gives them that extra part into it that you would.
But if they get £2,500, £3,000 a month, tax free,
yeah,
they're all right then.
Yeah.
So it pays for additional childcare and things like that because I wouldn't be around. So, there's all those kind of different benefits that are around that we can help our clients with. And it starts with communication and engagement.
Yep.
Let's understand where you are today. Holistic financial planning. What have you got? Where do you want to be? And let's create a plan in the middle, and protection will form part of that.
So you go through, just carrying on your pyramid.
Yep.
You go protection.
Yep.
You then go investments.
Yep. Well, yeah. We've got emergency fund at the bottom.
Emergency fund, yeah. So we've got emergency fund.
Yep.
Then we've got protection.
Yep.
Then we've got investment or pension investment. No. What's the next bit?
Yeah, so you've got like short-term, medium-term investments.
Yep.
So we'd probably put ISAs and unit trusts and things like that.
I never did understand ISAs. It's not one of those things that's ever. It's that whole thing of having my money locked up for too long that I can't touch.
Super easy. So emergency fund, protection, ISAs, unit trusts, that third tier up, if you like, of that pyramid, and there's only 4 in it, is more shorter term. So at 46, if I want money in 5 years' time, or 4 years' time, let's use my 50th. So if I want money at my 50th to go and
F1 somewhere probably, but yeah, or golf,
whatever it might be, or both, who knows?
Or both at the same time, yeah.
But if I want to do that, it's pointless having money in a pension because it's inaccessible. So I need some shorter term or medium term savings that are more liquid to me before I reach, an age at which I can draw down for my pension.
Yep.
And that's fine. ISAs are brilliant.
Okay.
The growth within an ISA is hugely, hugely tax efficient. Indeed, there's no tax taken off of you within an ISA.
Wow. Okay.
There's no tax taken off of you within a pension.
Yeah.
So in that respect, they're exactly the same. The difference is when you put your money in and you put £100 into your ISA and ask for a balance, it'll tell you that there's £100 in your ISA. If you put £100 into your pension, ask for a balance, it'll tell you it's £125 in your pension.
Yeah.
Okay, because you get 20% tax back that the government's taken off.
Yeah.
And if we're fortunate enough to be higher rate taxpayers, we can then reclaim the other additional 20% through our self-assessment tax return. Yes. Or 45% taxpayers, whatever you are. So, now going back to our little triangle.
Little pyramid, yep.
Emergency fund, protection, ISAs, and then pensions is at the top. So pensions is our longer term savings plan. I've heard it described as, Christmas dinner, for example. Christmas dinner is not in the fridge, it's not in the cupboard, it's in the freezer. The freezer's like our pension money.
Yeah, okay.
It's our longer term money. And then we've got our fridge, which has got our milk that'll last for 7 days, whatever it might be. And then we've got our larder and, maybe that'll last 2 or 3 days, whatever it might be. The point is, you've got different pots of money that are for different periods of our life.
Okay. So for our viewers and people watching that have got nothing, so they've got absolutely zero, they start by first communication, obviously, open a conversation, start to have a chat, because that's the base of where they should go, not to have a chat with their mate down the pub who says, you should,
we've all got a pub
you
financial
should go and
advisor.
invest in this and that, and because I've done this and I've done that. Actually talk to a professional. As you will notice through all of my podcasts, I tell you to talk to professionals when you need to talk to a professional. It sounds very crude, but what's the minimum amount that they should start with? What's the bit because there's no point throwing in the layman's terms, there's no point throwing in 50 quid into a pot because it's not going to give you enough return, if you get what I mean. So what should we be looking at as business owners? What's an average sort of, what should we be looking at, what we're going to spend?
I'm going to sound like a politician. I can't give you that figure because it's very much individual. What do you want out of it at the end of it? I think a few of the things, though, that you said there, which I found really, really interesting. I haven't got anything. Well, we all have got something somewhere. 90% of us, I'm sure, have got something somewhere. And by that, I mean we contracted out of SERPs maybe years ago. We work for other companies. There's a little pension pot there. How much is it worth? I say to my clients, the worst that will come out of this is a conversation. You'll at least know what you've got at the end of it. And there'll be a handshake. As long as you've got a kettle, everybody's happy. And
He likes Earl Grey.
I'm faux posh. So, we can have that conversation about what you've got. And then, well, how do I get to where I want to be? Or when's too late to start? These are the kind of questions that you're asking. It's never too late to start, but the earlier the better. How much should I be putting away? The best explanation that I ever heard of how much I should put away, it should be just enough so you feel it to be painful. That's when you're at the Goldilocks point, if you like.
Okay.
When it's just right. And it's just right when I do notice it, because you're supposed to notice it. Because if you don't notice it, to be honest, you're not putting enough away.
Okay.
And if it's too much,
then
if something comes up in the future,
you can knock it down a little bit.
If something comes up in the future, you're more inclined to say, I'm binning that off straight away.
Okay.
So that's too high.
Yeah.
And if you're not feeling it, it's too low. The bit in the middle is, I can just about feel it. And if something comes up in the future, do you know what? I'm just going to use this money I've got over here.
Yeah.
Because I want to keep that going.
Part. Yep.
And that's the right amount. So it depends how much you earn. Okay. The other thing, when you're talking to business owners, or if it's predominantly business owners listening to this, how much should I put in? Well, I've told you already, you can put in up to £60,000 a year. You can also go back up to 3 years and use any unused allowances there. And then arguably, if you've got enough float in your business to run the turnover plus a bit of tolerance, to run the cash flow plus a bit of tolerance, what are you keeping that other bit for? And if you're not doing anything for it, well, we can help you with that, because you're paying, guess what? You're paying corporation tax on it.
You are, yeah.
If you're in a bank account, you're getting at best 4% now.
Yeah.
Which is a great, one of the best returns we've seen in many years. We've come out of a period of historically low interest rates, so we're getting really good rates now. Yeah. And when markets are in turmoil,
but inflation is so high, it doesn't really matter. But that's a whole different conversation.
And if you're not in the market now, you'll only be buying when it's more expensive. So you might be able to get 4% in the banks now.
Goes back to the curve that we were talking about earlier on.
It's emotional investing. So 4% is great for our emergency funds, but anything in addition to that we can afford mentally to put away for 5 years and let this ride itself out, that's what those are the conversations that I have with my clients that they buy into.
Okay. So are we still talking pension then, as in putting it away, or are we talking other investments? Because
we can do hours on this. So thank you for the opportunity to just say that. I bang on about pensions because they've had such a bad rap over the years. I feel really, I don't know, delicate of them or defensive of them. They do a terrific job. But they are hungry beasts. They need to be fed a lot for a long period of time. And for that, you need communication and engagement with a decent financial advisor that's going to help you on that journey. Keep you on the straight and narrow. However, if we just park pensions for one second, within businesses and within companies, there are other forms of investment that we can have. Okay. We have corporate style investments.
Okay.
We can do that, which aren't pensions, and then you can draw off them from within the company. The other thing that we can help with...
Does that make it tax efficient? So if I took, as an example, if I have 50 grand sat over here, it's not part of my cash flow, it's not part of my tolerance, it is the spare lump that I've got here, and I go and stick it in an investment, does that mean I don't pay corp tax on it?
It depends on the type of investment that you're going into.
Okay.
Yep. And, we work with charities and things like that to help them with this issue, because they tend to hold a huge amount of cash on deposit, which then leads me to my third and final point really on it. If you weren't talking pensions and you weren't talking corporate investments, one of the things that we do very, very well as a company is we have partnered with a platform, if you like, whereby you open up a single account.
Okay.
One single account. And your money goes into that account, let's just call it that. However, from there, we're able to almost drag and drop our money into a variety of different accounts. So we are, well, maybe we're not all aware, but you are limited to £85,000 worth of protection from the powers that be on any monies that we've got on deposit. So if a bank fails, anything up to £85,000 covered. So many people don't want any more than £85,000 in an account. So if you're sitting on more than that, how do you manage that? It can be a little bit tedious, opening and closing accounts. So what we've been able to do for a lot of our business owners is allow them a single point of application to open up one account that then you can feed into a number of other banks and drop 30 grand, £85,000, 85, 60, whatever.
Yep.
And these different accounts that then you've got access to can be for different terms. Actually, I need instant access to that, so I'll have that account there. But this money here, I know that if I need that, I've probably got 30 days visibility of it. So I'll put that into a 30-day notice account because I'll get a slightly higher interest rate.
Okay.
This money down here is probably for a tax bill in 6 months' time. I'll put that in a 6-month deposit account with somebody else.
Bit higher interest rate again.
Higher interest rate potentially again. And I'm spreading my risk then over a number of banks, and they're all UK financial institutions, so you covered up to 85 grand. You've not had to go into each of these banks or set up a new application because it's all done through that single application at the top. And it's all visible
because
on
if
one
anybody
document.
has opened a bank account in the recent years, you'll know how difficult it was.
And it's tedious.
I
It's
tried
just
to open 2 during the last 3 years, and Jesus Christ.
just admin. So, we can take and alleviate all that. And, we help our business owners, spread that money around for different institutions.
Yeah, because it is that thing as a business owner for me is that thing of if and when I've got spare money sat in the pot, what do I do with it? My accountant will tell me to make sure it goes into my director's pension because that's what my accountant tells me every year is put money into your director's pension. And my hesitation on it is the fact of it's tied up. It's that thing of I put it in there, it's tied up, I haven't got it for X amount of years, depending on when we get to that age. But it's that thing of there are a lot of business owners out there like that. But if I've got somewhere that I can stick 40 grand for a period of time and actually it's going to make me a better return rate than sitting it in a savings account, why wouldn't I?
We can absolutely help our clients with that. But I think it was really interesting there that, my money's going to be tied up. I have had over the course of my career conversations with people that have said exactly the same thing. I don't want to put this 40 grand or 10 grand or 30 grand or whatever it might be into my pension because it's tied up. And then you go back and see them every 6 months. And guess what? After 8 years, it's still sitting there and you paid your tax on it.
With it. Yeah, it's still
and then it's like, I'll put it into a pension.
Well, you paid tax on it already.
If you'd have done that 8 years ago,
you wouldn't be paying tax on it.
What could it have been worth now? So these conversations there, you should absolutely cover, your cash flows within your business, and that's individual to your own businesses.
Yep.
Clearly, in my Maslow's hierarchy of needs idea, that's your emergency fund. Yeah. So I've covered that off. It's the bit on top that I'm talking about now.
Yeah, the cream.
The cream, and it's making sure that you're saving and mitigating tax wherever possible, and getting the money ultimately into the hands of those that you want it to. You predominantly.
Yeah, and
if
your
you're
family.
not here,
Your family.
the wife and the kids.
It's really
Simple,
good advice. Yeah, it is simple. Now you've explained it, it's simple. But beforehand, for me, because I don't have a ton of experience with the financial side of stuff, we have conversations and I understand what my pension does and that sort of stuff. But when you actually sit down and go through it and go, actually, I should have these protections in place as a business, as a father, as a husband. I should have these protections. But you sit there and you go through it, and it's that the not knowing or the unknown bit, which is the scary bit. And for business owners, and as we go back to business owners that, like a lot of us, didn't mean to be business owners. It wasn't that we were going to run a business. You don't know any of this stuff. And that's the sort of stuff that unless you are introduced to a financial advisor and you sit down and have a conversation, you're never going to know, or you're going to listen to your mate down the pub who's going to go, oh yeah, I've spoken to those financial advisors and what you really need to do is this, that. And we all know your mate down the pub knows nothing. Unless he's actually a financial advisor and you sit in the pub with him.
Wine bar. But
A wine bar, sorry, wine bar.
I'm clearly jesting. But, we work we deal well with accountants, we deal well with solicitors, because these are the people that you should be dialing into when you've got those specific issues or concerns within your businesses. You should have, if you're joint directors or 50-50 shareholders of businesses, I've lost count of how many business owners I've talked to about shareholder protection that have never heard of it. And it's hugely worrying because they just both assume in that scenario, I'll live past 65, we'll sell the business, it won't matter. And,
Yeah.
you have these conversations with people. Say, well, if you weren't here before then, would your partner want shares in this company, or would they prefer a big paycheck?
Yeah.
And 99% of the time,
They prefer a big paycheck
want a big
because it's
paycheck.
your passion, not your partner's passion.
so they just want the value of the business out. Well, that's what a cross-option agreement and shareholder protection comes into it. And then you talk about key man insurance or key person insurance, as it's called now. And that key person insurance, again, people don't understand it. If that vital person to your business isn't there, how are you gonna fix that?
Yeah.
And I went to a stonemasons years ago. Remember the story vividly. They were stonemasons in Hertfordshire. And we talked about key person insurance, and we talked about the key people in the company. So you've got the sales director, okay, hugely important because it's all their contacts. You've got the MD. If I wasn't here, the company wouldn't necessarily run. What about the CFO, the chief financial officer? Not a key person. But the guy out there that's got a mallet and a chisel,
It's actually doing the grunt
that's
work.
making it. That the call for that job. There's so few people out there that are doing it. That to bring somebody like that in, you'd have to pay 3 times his wage
to
get somebody
pull
with a
them away
contract.
from somewhere else. Yeah.
And that was what key person. That was the conversation that it went down. So it wasn't even the CFO. The key person then became, to be honest, the lowest paid person on the site
That's
who had
what
the
does the
highest
work.
skill.
Yeah.
So that's what key person is, and shareholder. It sits alongside that. Vitally important to business owners. And again, if you haven't got somebody to speak to about that, I'm sure they can reach out to yourself.
Yep.
And we
Stick
can
a comment in the comments below and we will hook you up with a connection.
and solicitors and accountants, we work alongside. And if you've got those 3 trusted people around you as a business owner,
I suppose if you're working with a really good accountant,
Yep.
this is my ad hoc brain thinking about it. If you're working with a really good accountant, they should be giving you the advice or introducing you to financial advisors anyway to help you, especially if your business is doing well. I don't mean if it's in dire straits, but if your business is doing well, then the accountant should be automatically introducing you to
well, it's that
financial advisors to go,
it's that coulda, woulda, shoulda thing, isn't it? Because I completely agree with you. Completely agree with you.
it's a synergy.
Because otherwise, you've got an accountant that's basically just filling out a tax return for you. Now, I work with a number of excellent accountants and I know your accountant as well, very proactive.
Yep.
Okay, and that's what you want. Guys, business owners, you're going to be paying this much corporation tax. There is a way to alleviate this burden by doing this before the end of your tax year.
Speak here.
Go and speak
Here's
to
an
Phil,
intro. Yeah.
speak to Phil, speak to whoever you're using at the moment. So that's why accountants being proactive.
I know so many business owners that don't have that in their corner.
I
though,
know
as
so
an
many accountants that
accountant.
don't think about it.
Well,
All
yeah.
they're interested in is just doing the tax return. And if your accountant is doing that, then if you take anything else away from this, and it's not for me,
Yeah.
it's more about go to your accountant and say, well, listen, how can I alleviate this tax burden? If they're not offering you,
the advice.
sound guidance on where you can go, then
I was always
reach out.
taught and told when I opened my business from lots of different business owners that had been going for a very long time was your accountant should always at minimum save you the cost of them per year in what they're helping you. If not, double, triple, because their advice, they should be advising you to speak to financial advisors and so on. It's an interesting world that we live in, Philip.
Which sounds like a nice place.
It does. It does indeed. Well, hope you've enjoyed the podcast. Thank you very much for coming along and chatting. I hope it didn't scare you too much.
I think I've made my way through it.
Yeah, I think you've done well. You've done well. And if you would like to see more, subscribe, hit the like button and leave us a comment. And if you want to speak to Phil, definitely leave us a comment and we'll hook you up with Phil. Take care.